Anthony Grasso here, bringing you financial news you can use. In this video, I'm going to do a stock analysis and recommendation on Hannon Armstrong Sustainable Infrastructure. Now, folks, if you would like to hedge a bet for any future solar EV market correction in the future, this might be the video you might want to watch. Okay, so I'm going to go over a summary of the company, its product offerings, recent headline news, financials, analyst projections, and give it my buy, hold, or sell recommendation for both the short term and the long term. And as always, folks, don't forget to smash that like button down below and consider subscribing and hit that notification bell if you like to hear daily stock recommendations and reviews. So let's get right into it. So let's describe what this company does and then analyze in terms that we can understand. So the company makes investments in climate solutions by providing capital to leading companies in energy efficiency, renewable energy, and other sustainable infrastructure markets. Now, the goal is to generate attractive return from a diversified portfolio of projects with long-term predictable cash flows from proven technologies that reduce carbon emissions or increase resilience to climate change. Now, their investments have taken many forms, including equity, joint ventures, land ownership, lending, and other financing transactions. They also generate ongoing fees through a gain on sale securitization transactions, services, and asset management. Now, let me put this in terms that we can all understand what they exactly do and what they're going to do in the future. They are a real estate investment trust, or REIT. On all REITs own, develop, and operate a portfolio of real estate investments or assets. The company is well diversified and operates in three large market segments. The segments are behind the meter, grid connected, sustainable infrastructure. The company owns clean energy real estate assets, but that's not all of what it does. This isn't as simple as saying renewable energy plus real estate equals profits. Now let's dive a little deeper into the company to take a look at what makes investing in this segment seem so compelling and what investors need to know about Hannon Armstrong. So owning and operating renewable energy assets has been relatively stable. They tend to generate stable revenue under long-term contracts. They come with generous tax breaks and incentives, and the cost of maintenance is relatively low. Now, real estate investment trusts tend to come in two different flavors: equity REITs and mortgage REITs. Now, equity REITs are the ones that own and lease physical real estate to tenants, whereas mortgage REITs buy, own, and manage a portfolio of real estate-backed mortgages. A mortgage REIT generates profits by buying mortgages with higher interest rates than the debt it issues to buy them. Now, Hannon Armstrong is a bit of like a hybrid between those two things. It's both an equity trust and a real estate trust. Equity REIT and a mortgage REIT. It owns physical real estate, but that's only about 15% of its total portfolio. Those physical property investments are for land upon which developers build utility-scale power, solar power facilities. It then collects rent from the company that owns the power-generating assets. Other parts of the portfolio are similar to mortgage REITs. For example, a significant portion of its assets are residential, commercial, and industrial solar leases. A solar lease is a contract payment that an owner of a building pays a solar developer for a rooftop solar system. They can either be a conventional loan payment or a power purchase agreement where they pay for the amount of electricity that the solar system produces. Now, Hannon Armstrong helps developers finance the upfront cost to build those solar systems and gets an ownership stake in each contract. According to management, about 37% of its portfolio consists of these kind of solar leases. Now, the difference between a solar lease and a conventional mortgage, though, is that the solar systems aren't an appreciation asset. Solar systems degrade over time and typically need to be replaced every 10 to 20 years. Now, more comparable to a solar lease is like an automotive loan. It may be backed by a physical asset, but that asset's value depreciates over time. But here's the thing. This is only one example of the different kinds of investments that Hannon Armstrong makes in its sector. Overall, the company issued loans to water remediation projects and other climate change related projects and manages small scale utilities such as university power plants. Now, many of the company's investment opportunities are intriguing, but the collection of all of these types of assets under a single portfolio makes it more difficult to understand what the company owns and how to follow the financials and fundamentals of the company, because they own so much and they're everywhere. Also, because the company is in business of project and development finance, it carries much higher debt levels than a conventional equity REIT. Hannon Armstrong's debt to capital ratio currently stands at about 58%. Now, that's a tad higher than an equity REIT, but more in line with what you would expect from a mortgage REIT. Now, let's go ahead and look at some news of the company. So the Hannon Armstrong announced that its fourth quarter and full year 2020 earnings release date and conference call will be on February 18th, 2021. So look out for that. I think they might even surpass their projected earnings. And then recently, Hannon Armstrong was named to Real Leaders Top Impact Companies list of 2021. It was in recognition of its pioneering approach and commitment to climate positive investing. But hey, let's now go back into look at the fundamentals of the company right now. So the company has a market capitalization currently of 5.05 billion and is currently trading at $65.52 a share. Now, revenues have been steadily increasing over the years, and earnings grew by about 134.9% over the past year. Now, let's bring it back over here. Now, these earnings are high quality, and the current net profit margins are higher than last year of 63.4%. Now, let's look at the balance sheet. Now, this company is taking advantage of historically low interest rates right now to pay off maturing debt and fix the interest rate on as much of its debt as possible. Today, 99% of its debt is fixed rate, and much of its non-recourse debt largely self-amortizes within a contracted terms of the individual assets themselves. The company also has shown its financial strength by issuing debt on very attractive terms in 2020. It raised about $375 million in unsecured green bonds at a rate of 3.7% interest rate that does not mature until 2030, and also issued $144 million in convertible green bonds that matures in 2023 at an incredible 0% interest rate with a conversion price of $48.36. Now, with a reasonable 2.0 times debt to equity ratio on an investment portfolio that contains a lot of debt investments, which are by nature more conservative than equity investments, and $881 million in cash, the S&P has given them a BB plus credit rating that management hopes can be upgraded to an investment grade soon. That would be huge news for this company, and the stock price would definitely increase when that would happen. Their recourse debt maturities are very well laddered, with no maturities up until 2022, and the vast majority not maturing until 2024 or later. Now let's look at some of the analysis. Now, looking at the valuation analysis, because the company is in the equity real estate investment trust REIT industry and has positive earnings, the price to equity and the price to book ratio is the most appropriate valuation measures. The price to sales ratio is less instructive than the price to earnings, since the company has positive earnings. Therefore, the company seems fairly valued with the price to earnings value 46.18 times. That is in line with the equity real estate investment trust industry median of 38.57 times. Now, looking at the profitability analysis, despite a lower than medium gross margin, the net and operating margins at the company are both among the highest in the equity real estate investment trust industry. This could mean that the company pays out a smaller percentage of its revenues to fixed operating costs than its peers. Now, looking at the dividend analysis, the company pays an annual dividend of $1.36, which at its current stock price provides a yield of 2.03%. In comparison, the average stock in the S&P 500 index funds yields 1.73%, while other companies in the equity real estate investment trust REITs pay about 4.95%. So if you're looking at it from a dividend standpoint, there might be other REITs you might want to look at than this one in particular. So what did the analysts say about this? Now, the analyst consensus is a buy, 30% are a strong buy, 40% are a buy, and 30% are a hold. The average stock price target is $63.89 with a high estimate of $80 and a low estimate of $48 over the next 12 months. So it's trading slightly above the average. Now, going over the few of the analyst reports, the street ratings is a buy with a target price over the next 12 months at $90.37. They said the company's strengths can be seen in multiple areas, such as the robust revenue growth, solid stock price performance, impressive record of earnings per share growth, notable return on equity, and a good cash flow from operations. They feel its strengths outweigh the fact that the company has had generally high debt management risk by most measures that they evaluated, but I think they're doing great on their debt management, as I discussed before on the talking about their balance sheet. Now, the Forward Equity Research has a hold recommendation on the company as a result of their systematic analysis on the three basic characteristics: earning strength, relative valuation, and recent stock price movements. The company has suffered a very negative trend in earnings per share over the past 5 quarters, though. While recent estimates for the company have been raised by analysts, the company has posted better than expected results, though. That's good news. Based on the operating earnings yield, the company is about fairly valued when compared to all the other companies they cover. Share price changes over the past year indicate the company will perform very well over the near term, and I agree with that sentiment as well. The ownership breakdown of the company is 86.8% institutions, general public own 10.6%, individual insiders own 2.6%. It is important to note that insiders have only sold shares in the past 3 months, and that shareholders have been diluted in the past year, with total shares outstanding growing by 15.5% last year. So my buy, hold, or sell recommendation on Hannon Armstrong Sustainable Infrastructure, here are my thoughts. Now, when you actually look under the hood at Hannon Armstrong, which we all should do, you see that it's not just a real estate investment in the conventional sense. The absent of a portfolio property, Hannon's fortunes will be determined by its ability to secure financing at low interest rates, then lend it at higher interest rates to renewable power and other sustainable infrastructure projects. And with the Fed keeping the interest rate at around 0 right now, I think they're going to be able to do that in the future over the next couple years. And I don't see them jumping up that interest rate anytime soon. Being able to identify high return projects with low probabilities of defaults means that this REIT investment is wholly reliant on the management's underwriting ability to make good judgments, and I think they've made good judgments in the past historically, and you should look at historical data and see exactly if they're going to perform good in the future with their decisions, and I think they made good judgments. Now, for those looking for a simple investment backed by physical assets like real estate, this company isn't it. Now, let's look at the overall macroeconomic conditions for this company, because that's important to note. Renewable energy has been proven to be wildly profitable investment over the past year. Now, with Democrats controlling Congress and the White House for at least the next 2 years, the tailwinds for renewable energy should only increase. So that the company does appear poised to continue to thrive and build on their market-crushing performance and strong dividend growth track records. The company's 12-month pipeline is quite substantial relative to its current portfolio size and heavily favors conservative, behind-the-meter investments. Also note that this REIT would hedge your bets if other clean energy stocks were to come crashing down. If the market does turn and everything comes crashing down, this will be like your hedge bet. Now, looking at other clean energy stocks outside this company, after an incredible run over the past 6 months, it seems like clean energy stocks look like they're reaching a bubble territory. I'm not saying it's a bubble, but it looks like it. Price to earnings ratios are stretched, dividend yields are dropping, and the industry may not grow as much as investors are expecting over the next decade. So based on all of that, I am a long-term and short-term bull on this real estate investment trust. Seeing the price at a $65 mark, I feel it is a good jumping in point with a year target price of around $85 to $90 a share by the end of 2021. Now, this would be your defensive investment in your portfolio that can take advantage if the weekend market approaches and the market definitely declines. Now, but if you're a dividend investor, though, there are other companies in the REITs that pay out a higher percentage of around 4.95%. So you might want to avoid this one if you're specifically a dividend investor. So there you have it, folks. As always, don't forget to smash that like button down below and consider subscribing and hit that notification bell if you like to hear daily stock recommendation and analysis. Until the next stock update video later today or tomorrow morning, ciao.